So we are continuing looking at our partnership changes. Welcome back. This is part 2 of looking at changes in partnership using our example question from the A-Level Accounting book by Harold Randall, exercise 2 in chapter 7 with Crook, Shank, and Spindle. And earlier in our part 1 of our video, we calculated our loan interest and we recognized that the loan came into the partnership on the 1st of October, and that is when the partnership changed at an annual interest rate of 12% per annum. So therefore, there was no loan between April 1st and 30th of September 19-1. So therefore, we will not have any loan interest for that period. But from October 1st, 19-1 to 31st of March 19-2, we had a loan of $10,000 at an interest rate of 12% per annum. And we had to calculate then our interest rate for our loan for that period. So our next expense that we're looking to calculate then will be the depreciation on our vehicles, or in other words, depreciation on our assets. So we're looking at motor cars. So we're looking at motor cars. And we're looking at the depreciation on these motor vehicles. Now, in the question, we have motor vehicles at the beginning of the financial year at a cost of $20,000. So we have to calculate the interest rate for those motor vehicles, the cost of $20,000, and that is for the entire year. The interest rate on the motor vehicle is 20% per annum. So we had those motor vehicles from the beginning of April 19-1 until the 31st of March 19-2. So therefore, the depreciation on those motor vehicles would be 20% on the $20,000. However, when we are looking at these motor vehicles, we must recognize that we had those motor vehicles between April 1st and 30th of September. So therefore, some of that depreciation will go, half of the depreciation will go for that period. And then we also had the same motor vehicles between October 1st and 31st of March. So the other half will go for the other half of the period when we had our new admission of our partners. So we have $20,000 times 20%, and that would give us $4,000 for the year. Okay. Secondly, we have to take a look at the fact that on the 1st of October, Spindle, he bought in a motor vehicle at $8,000. So if he bought in a motor vehicle at $8,000, it stands then to reason that this motor vehicle will also be calculated at 20%, which is the depreciation rate. However, since this motor vehicle was there only for 6 months of the accounting period or 6 months of the financial year, then it will only incur depreciation for 6 months of the year rather than for the full year. So let's look at calculating the depreciation. So for the motor vehicles that we had at the beginning, be $20,000. $20,000 times 20%, which is 0.2, and that is divided by 2, which is $2,000. Then we have our second vehicle, the same vehicle again, $20,000 times 0.2 divided by 2 plus our vehicle that costs $8,000 times 20%, and that is divided by 2, which is $2,800. So the total depreciation for the year would be $2,000 for the first part of the year and $2,800 for the second part of the year, which would give us total depreciation of $4,800. So then let's look at, so we have allowance for doubtful debts, and our allowance for doubtful debts at the beginning of the year, that allowance was $500 on the allowance account. But they're telling us in note, they're telling us here, so at, this is $500, but they're telling us here in note 5 that allowance for doubtful debts is to be maintained at the rate of 4% of receivables. So we have receivables from the 1st of April to the 30th of September of $12,000. So we have to calculate 4% of this. And then we have receivables from the 1st of October to the 31st of March of $14,000. So we also have to find 4% of this as well. So let's look at that. So we have allowance for doubtful debts, and that would be equals to $12,000 times 4%, which is 0.04. And someone may be wondering how I'm getting these decimal numbers. Remember that percentage is out of 100, so therefore if it's 4%, it's 4 divided by 100, and that would give you, if you take the 4 and divide it by 100, you will get 0.04. So that's how I'm getting these decimals, and that is $480. However, we must be mindful of the fact that the allowance previously was $500. So the allowance previously was $500. So the allowance, and that's at the beginning of the year. So our allowance at the beginning of the year was $500. But now that we've come to 30th of September and we calculate our allowance was $480, which means that our allowance for doubtful debts decreased. It went from $500 down to $480. So there's a reduction in the allowance for doubtful debts. And when we have a reduction in our allowance for doubtful debts, the reduction would become as other income, which would increase our profits. So that extra, which is $20, can be added to our gross profit here of other income. So if we had done it earlier, we could have added here as other income, and then we would have prorated here. However, since we're doing it here and it's other income and not an expense, we cannot have it being added here in our expenses. So we would, when we are at total our expenses, we will subtract that 20. So that is this minus 500, which gives us $20, which will be deducted. So this is for the first period. This is our allowance for the first period. So now let's look at the allowance for the second period. So from October 1st to March 31st, our receivables were $1,400. So now that would be $14,000, sorry, times 4%, And remember that the allowance that we calculated up to the end of September was $480. So when we calculate our allowance, so now we have calculated our allowance from October 1st to March 31st, our allowance has increased. So our allowance have moved from 480 up to 560. So there is an increase in our allowance for doubtful debts. And if there's an increase in our allowance for doubtful debts, it means then that that would increase our expenses. So it's also added as part of our expenses. So and it's not the 560, but the difference between the 480 and the 560. You must make note of that. So this is minus 480, which gives us an increase. So our allowance for doubtful debts increased between October 1st and March 31st to an estimated $80. Our allowance for doubtful debts decreased between 1st of April and the 30th of September by $20. So then the total allowance for the period is $60. Our next expense, we having more expenses? No. So that's our last expense for the period. So now we can total our expenses. So it equals so we have total expenses for April to September of $18,480, and total expenses from October to 31st of March of $20,380, and our total expenses for the financial year would be total expenses for the financial year So our total expenses for the financial year, $38,860. So now what we're going to do is that we're going to calculate our net profit, and our net profit would be our gross profit minus our total expenses will give us our net profit for our period. So let's see the net profit that the partnership made between April 1st and 30th of September. So our net profit. So our net profit for the period April 1st to 30th of September is $11,520. And our net profit for the period October 1st to 31st of March is $39,620. So our net profit for the entire year would have been a grand total of $51,140. So now that is our net profit. So now we have to look at the appropriation of this profit here between our partners. So we have to appropriate this profit, and when we say appropriate this profit, we have to share the profits between the partners based on the time period. But before we can share the profits, we have to look to see if you would have had drawings. So if the owners had drawings during the period and they had interest on those drawings, then the interest on the drawings would be added to your net profit. And remember, we when you're looking at partnerships and you're looking at interest on drawings, we are looking at the fact that the interest is charged on drawings as a means, as a deterrent to stop the partners from withdrawing profits from out of the business. So it's kind of acting like a deterrent. So if there is interest on drawings, those interest on drawings will be added to our profits. So we don't have any drawings, neither do we have any interest on drawings, so we cannot add any interest on drawings here. But then the next thing we have to look at is that we have to take out the interest on capital. So our partners will be getting interest on their capital, and the agreement states that the new partnership arrangement allows interest on cash introduced as capital at 10% per annum. So under the old partnership agreement between Crook and Shank, there was no interest on capital. No interest on capital between Crook and Shank. However, now that they have admitted Spindle as a partner, and Spindle is bringing in capital into the business as well, they have drafted a new agreement and have decided that they are going to give each partner 10% of this capital here. So our interest on capital and so we're going to calculate our interest on capital, and our interest on capital is subtracted from the profits so that we can see the remaining profits that can be shared between the partners. So that's interest on capital, and this is interest on capital for Crook, Shank, and Spindle. And this interest on capital is at 10%. So the Crook had capital of $40,000 at the beginning. So that is $40,000 times 10%, and that will be divided by 2. Shank had capital of $30,000. I think I mentioned earlier I said 20, but his capital is $30,000. So his interest will be $30,000 times 10%, and that's also divided by 2. So I'm showing some work in here so that you can see clearly where I'm getting some of my figures from. And Spindle introduced, I think it was $20,000 into the partnership. Yeah, it was $20,000 that he paid into the bank account, but then he also bought in a car of $8,000, so his total capital then would be the $20,000 plus the value of the car of $8,000, so his total capital is $28,000. So Spindle's capital, $20,000 plus $8,000, which is equals to $28,000, and that is multiplied by 10%. And then that 10% is divided by 2. And that 10% is divided by 2. So I just want to show you this working so that you can see it, because when I put it in the formula, it will not be really necessary seeing this working here. I'm going to make it stand out, that you can see clearly that this is some working of how I calculated some of the figures you are seeing here. So we are seeing that there was no interest on drawing 000 for this period here, but then here there was interest on drawings $40,000 times 0.1, which is 10% divided by 2. So interest on his capital, sorry, I think I said drawings, his interest on capital is $2,000. For a crook, for a shank, $30,000 times 0.1 divided by 2. So his interest on capital is $1,500. And for spindle, it is $28,000 times 0.1 divided by 2. $28,000 times 0.1 divided by 2. So interest on capital for crook $2,000, spindle $1,500, and sorry, shank $1,500 and spindle $1,400. So that would give a total interest on capital of $4,900. So after we have taken out our interest on capital, the next thing to do is to subtract any salaries that was being paid to the partners, and remember that a salary paid to a partner is not like an office worker who is being paid, because the office worker who is being paid, salary and wages are here in our profit and loss statement here. But the salary for a partner is something like a drawing. That is some of the profits that he's getting before they actually share the profits between each other in their profit sharing ratio. And maybe he's getting this extra, maybe because he specializes in a particular area, or maybe because he might be spending the majority of the time at the business or whatever, doing whatever that needs to be done, and he's being offered something extra per annum. So when we look at the question here, neither crook or shank is being given any salary, but when we come to the new agreement, it has been agreed that since we're bringing in spindle will be given salary of $4,000 per annum. So the salary for spindle, so the only person that is receiving salary is spindle, and that is $4,000 per annum. He wasn't here in this period, so this is 0, but he was here in this period, so it's $4,000. However, as I said, he was not there for the entire year, so he cannot get the $4,000 for the entire year. He was only there for 6 months, so he can only get salary for 6 months, which is $2,000. $2,000. So the amount, the profits to be shared here. So let me come here. We still have, sorry. That's 0, 0. So therefore we have our profits to be, our remaining profits for the first period of year would be the profits we had here minus anything from here, which is the same 11,520. So our profits have not changed, no change at all for the first period, because in the first period we didn't have any interest on capital. No one had a salary, so our net profit to be shared among the partners for April to September is the same 11,520. So now that we are looking at here, profits to be shared for the 1st of October to 31st of March would be our 39,620 minus our 4,900 plus our 2,000, which gives us $32,720 to be shared. Which gives total profits to be shared for the year of $44,240. So the profits that are to be shared among our partners for for April to September is 11,520, and for October to 31st of March is 32,720, and we have to share these profits among these partners according to their profit sharing ratio. So share of profits, and we are sharing profits to Kroc, Shank, and Spindle. So who we are sharing profits to, and our question stated that when we look at the first period, which is April 1st to September 30th, the profit share, the Kroc and Shank, they're the general dealers, and they're sharing profits and losses of the ratio in the ratio of 3 to 5. So that means Kroc is getting 3 parts and Shank is getting 2 parts. And we know with ratios, if you add the 2 parts together, you get the whole. So which meaning that Kroc will be getting 3/5 of the profits and Shank will be getting 2/5 of the profits. So let's look at for the first period. Again, it's surely working. First, before I put it in the formula, Kroc will be getting 11,520 times 3 on 5, and Shank will be getting Shank will be getting 11,520 times 2 on 5. So that's for the first period. So here we have crop that equals 2 times 2 on 5. So Crook is getting $6,912 out of the 11,520, and Shank will receive $4,608. Spindle will get 0 because that he was not there between the 1st of April and the 30th of September. So then for the second period, we have Crook will be getting, so let's look at the ratio here. So seeing that they have the new agreement, they said Spindle will receive a salary of $4,000 per annum, and the balance of profits or losses will be divided as follows. Crook will get 2/5, Shank will get 2/5, and Spindle will get 1/5. So here we have that Crook is out of the 32,720, Crook will be getting 2/5. And Shank will be getting 2/5 as well. So both of those are getting the same share of profits out of according to the agreement. However, Spindle will be only getting 1/5 of that profit. So let's look at the profit for these partners now. So that is equals times 2 on 5. So we will see that from October 1st until March 30th, Crook will get $13,088. Shank will get the same $13,088, but Spindle will only get $6,544 as their share of profits. So you will see that for the year, Crook get $20,000 in profits, Spindle gets $17,696, and Crook gets $20,000, Shank gets $17,696, and Spindle $6,544, which gives us the total profits of $44,240. So this is our question of partnership changes. What I'm going to do is that I'm just going to format it a bit more so you can see what is happening here. So doing a little formatting here so that you can see where the totals are clearly. And we see that we are subtracting from there. So we have our profits here that we're sharing. So that's for expenses. So making certain things stand out. Format ourselves clearly see. So here we have our question. Very nicely done. Of course, shank and spindle. Again, this is the question here where we can read what was required. And this is the income statement and statement of appropriation. And select here, separate the periods. So you can see a clear separation of the periods. So you will see that this is our period here of April to September, October to March, and these are totals. So our sales less cost of goods sold give us $90,000. This is shared as a third, 2/3. Then we share our expenses, we prorate our expenses, get our total expenses. So our total expenses deducted from our, total expenses deducted from our gross profit give us our net profit. And from our net profit, we took interest on capital, and we also took our salary. which give us our profits to share, and we share the profits for the first half of the financial year between Crook and Shank only, and then our profits for the second half of the year were shared between Crook, Shank, and Spindle. So that's it for this topic on partnership changes so far, and listen out for some more from me with reference to partnership changes, because we have to start looking at when there's goodwill and when they're revaluing assets. So partnership changes.